In October 2025, Bitcoin crossed $126,000, surpassing every previous valuation and creating a fresh wave of newly minted millionaires. Within 6 months, that price crashed back to a $65,000 baseline, erasing nearly half the market's value. This happened despite the 2024 halving. For a decade, investors treated the supply cut as a guaranteed bull run, but for the first time, this correlation fractured. Institutional funds that promised stable diamond hands were the first to sell, leaving retail investors who bought at the six-figure mark with significant losses. The failure of the post-halving bounce suggests that the mechanics driving the price have shifted away from the predictable 4-year cycle of the past. In 2012, the halving cut new supply by 50 BTC per block, when daily trading volume was negligible. By 2024, the reduction to 3.125 BTC meant only 450 new coins entered a market that now trades millions. Miners' contribution to total supply has become a fraction of a percent of daily liquidity. The price is now dictated by the total money circulating in the global economy and the specific interest rate targets set here at the Federal Reserve. When the Fed paused rate cuts and held the benchmark at 3.75%, it restricted capital needed for $100,000 prices. Consequently, Bitcoin's correlation with the S&P 500 reached 89%, moving in identical patterns with traditional equities. Bitcoin tracks the same liquidity patterns as NVIDIA or Apple. When the Federal Reserve restricts the money supply, Bitcoin drops alongside the Nasdaq. The launch of Spot ETFs was expected to create a floor of institutional buyers, but the first quarter of 2026 saw $7 billion in net outflows from these funds. Fund managers are prioritizing stability. With inflation remaining high, they are exiting high-risk positions to capture 5% yields offered by the Treasury Department. This creates a loop. Institutional selling triggers a price drop, which shows up on Coinbase and retail apps, causing smaller investors to sell their holdings and driving the price even lower. These institutional shifts mean Bitcoin now reacts to the dollar's strength, rather than serving as a hedge against its inflation. Bitcoin acts as a high beta trade on the American economy. If unemployment figures rise or consumer spending drops, Bitcoin tracks the economic pain in real time. While retail traders debate cycle theories on social media, institutional whales are ignoring the hype and focusing on the floor of the mining market. JP Morgan estimates it costs $77,000 to mine one Bitcoin, meaning the market is trading well below the industry break-even point. This forces miner capitulation. Miners must shut down hardware and sell remaining reserves, adding huge sell pressure. Smart money is avoiding the vertical rallies and instead layering buy orders between $50,000 and $60,000, while moving a portion of their capital into AI infrastructure companies like Microsoft. In this phase, buyers waiting for a guaranteed halving moonshot are primarily serving as the liquidity that allows institutions to exit their earlier positions. The data doesn't point to a $30,000 crash or a quick return to $100,000. Instead, it suggests a period of sideways exhaustion where the price remains stagnant for months. For a sustained recovery, the Federal Reserve must lower interest rates below 3%, which would increase the supply of cheap capital available for risky assets. There is also a legislative hurdle. Passing the Clarity Act provides the legal framework necessary for commercial banks to hold Bitcoin on their balance sheets. Bitcoin enters a maturation phase, behaving like a conservative 1% insurance policy against the $34 trillion national debt, rather than a speculative lottery ticket. To capture a 30% return, an investor must be willing to endure 40% drawdowns and base their strategy on macroeconomic data rather than social media predictions.